because we've had these experiences, and there's just things that's like, gosh, I wish I had known in my 20s the things that I know now.
They're really hitting the top of the game. The CEOs are in the succession are becoming the CEOs.
This is the adult reality of making hard choices.
And some of that is you learn by trying. Like, there's just no other way to do it.
And you just keep moving, You just keep moving.
Yeah. You do your best, but once you know better, you do better.
Instead of looking at things that were worse, things that were better, it was like I was blown away at my staff. I'm like, I thought they couldn't do anything without me there.
When something keeps happening over and over again, you can think it must be them, but you have to take on that it's you.
Now, when I've said that to entrepreneurial groups, they all get nervous. Oh, I could never do that. I could never do that.
Oh, this is like a whole new way of looking at this situation and a whole skill set.
And we're not in this alone.
In the immortal words of John Baldoni here on Bestseller Live, you are not alone. We're not doing it alone. I've got Steve Blewitt with me today. Cynthia is off today, and we will be back next week together for another episode. But like I said, Steve Blewitt is with us today. He's a former chief investment officer of private markets at Manulife Investment Management, where he led global investment teams across private equity, private credit, and real assets. He's the founder of Private Markets Navigator and co-founder of YouthWork.Connect. His new book, Investing in Private Market Funds, Institutional Strategies for Individual Investors, translates institutional investment practices into practical guidance for individual investors. And I'm so pleased to have him on the show today. Steve, welcome.
Thanks, Rhett.
It is great. Well, tell me, why did you write the book, Investing in Private Markets, and why now? And that this book is so easy to read. It makes it so understandable that the terms and the jargon and all the things that are a little bit overwhelming if you think about investing. You think about the stock market and Wall Street, and it can kind of, for a lot of people, be a little bit overwhelming. So this really, I think, helped me understand it better. But I want to get your take.
Yeah, no, I appreciate that, and that was something in terms of making it digestible to the reader that I really strive for. So I appreciate you saying that. So why this book and why now is I had a very long career, as you mentioned, at Manulife, and most of my career was investing in private market assets, and I was both a direct investor, but I was also a manager of funds that we sold to other institutional clients. And I retired from Manulife in 2023. I spent a year at the University of Chicago in a program that's focused on social impact called Leadership in Society. And my wife and I have created a not-for-profit. You mentioned YouthWork.Connect, which I'm happy to talk about as well. But it was really in that year, in 2023, carrying into 2024, that I realized I just had a tremendous passion for private markets. I really enjoyed it. And I also saw that there was a growing interest by individuals to invest in private markets. And there was a growing supply of products being offered to individuals. And what I wanted to do was to write articles, which ultimately then became a book about how individuals should approach investing in private markets.
What do institutional investors know about private markets and about investing in general that most individual investors don't?
Yeah, I think as it relates to private markets, the thing that was most important to me as an investor, and to people who I knew well in the industry, and people who were challenging me as a fund manager and asking me a lot of questions as to why they would potentially want to invest in the funds that we offered, was that there was what the term is dispersion, but there's a wide range of returns that managers deliver for investors, much wider in private markets than in public markets, and which really brought the importance of manager selection, who you were investing with, is just a critical thing. And my belief is that that's very well known within institutional channels, and these institutions spend a lot of time making sure that they select managers properly. And I don't believe at this point it's as well known with individuals. And that was something that I really wanted to communicate in the book.
What do you think about all these new tools? I mean, my sons like, things like Robinhood and some of these other tools that you put into Chat or Claude or something, what you want to do, and it gives you a strategy. How do you feel about that? I don't use them myself, and so I'm probably not like the best person. But one of the things that I've heard is that as you grow, and I believe, not just heard, but as you grow personal wealth, having that personal relationship becomes more and more important. And so, like, I spend a lot professionally, I spent a lot of time talking to advisors, helping me think about different ways to invest and learning about different parts of the market. And as an individual investor, I follow the same thing, trying to talk to as many people and build relationships with as many people to be informed. So I'm less reliant upon like a specific tool that may spit out, a more generic answer than one that fits, my family more, perfect. Yeah, I think that's wise, right? I think we've missed today some of that personal, those personal relationships and an advisor maybe getting to know you better and your needs and the things that you want and the reason why you're building wealth, and
right,
understanding your relationship with money and your family goals. And I'm not sure that AI can duplicate that, right? I don't know that it like you said, it can be pretty generic. And so, I think it's a great tool. I think it's great research. You can do some great research on it, but you still have to do research, right?
Right. And in, just to expand upon what you were saying, because I think this is, really important part, is unless you feed in all of the information, what your legacy intent is, right, for your wealth, or whether you have insurance policies over here or you have a second home over there, unless you right, feed it all in, the AI is not going to see the complete picture. And if you have a good relationship with a good financial advisor, they would be asking you those questions, pulling those out so that they can see the total picture. And I think that's really important.
Yeah, I 100% agree with that. What private equity and private credit are becoming much more accessible, as we were talking about. Is that necessarily a good thing for individual investors?
Yeah, I think it is.
Is it risky? Is it risky? Is it?
So there's risks. There's sure, the way I think about it is there's risks associated with anything in investing, but anything with private markets generally. And then what we all have to think about is whether or not the benefits outweigh those risks. So one of the things, access to the private equity, private credit, et cetera, is growing. And one of the reasons why I wrote the book is I think that access is growing faster than knowledge of the market. So I wanted to try and close that knowledge gap, if you will. So I personally think growing access is fantastic. It doesn't necessarily mean that everyone should be buying the products. And that's really where one hopefully will make informed decisions. And one of the things I was trying to get at with the book.
What are the biggest risks in those investments?
Yeah, so I think the thing that people talk the most about, well, a couple of things that people talk the most about is lack of liquidity. So if you're in a traditional private markets fund, you put the money in and you really can't get it out until it's distributed out, and the timing of those cash flows can be very, very variable, very uncertain. There are newer products, they call them semi-liquid or evergreen products, where you put your money in and you have the ability to get the money out. You can redeem the cash. But having said that, is if there's a lot of people trying to get the money out at the same time, those redemptions can be basically halted, and the term is gated in the community. And we've seen that over the last couple of quarters with private credit funds, where people wanted their money out. For some fund managers, they couldn't get it out. So that's clearly a risk, that if you need the money and you may not be able to get it out, then it could cause other issues in your portfolio. The other thing that folks focus a lot on is high fees. It is to originate these deals, to manage these investments, et cetera, is expensive. And so there are higher fees associated with managing private assets. The way I think folks should get around that or think about that is just look at what am I earning net of all those fees, and is it better than investing in some public market investment or not? And I think ultimately one needs to just consider the fees. The risk that I don't think people spend as much time thinking about, though, is just a lack of sort of transparency in what you may own in those funds. And what that may mean is you may be taking on like risk exposure that you never thought about. Like you may be taking something that's very you thought it was not as risky because it had a label on it that didn't sound as risky, but maybe it was riskier. You didn't understand the valuations that you were getting in. So I can go through a bunch of different things, but the lack of transparency, I personally think, is the bigger risk than liquidity and higher fees.
Well, that was really my next question, was what are the sort of top three things when you're evaluating one of these investments? When you said, okay, the price obviously is versus, but you just mentioned a couple other sort of risk and maybe liability. What are some of those? What are the other two things? Maybe you talked about price. So what are the other two things that when you're evaluating a private market fund, what are some of the other questions you should be asking? Yeah. So to me, the most important thing, and maybe taking a step back, is whether I should be investing in a private market fund. Fair enough. Understanding, where does what I'm being offered fit? Can I get that risk, and can I get a better return somewhere else? So there's parts of private markets that look exactly like parts of public markets, and that's okay. You may want to add that exposure. There may be better value in private markets than public markets, but fundamentally, just really trying to understand what's the risk that I'm taking, and am I better doing it in private markets than in public markets? And then the second thing, just again going back to the manager selection and choosing the fund managers, is really understanding how those managers create value. And it's something that the first time through, maybe you don't fully get it, but if you build a script and you talk to a lot of different people and you ask the same questions over, you get a sense, is this something that a fund manager may have been lucky and delivered great returns, or do they have a repeatable process in place and a deep team that can add value over time to generate those persistently strong returns? So I think that's something that I would really focus on as well. I'm glad you brought that up, because I was going to say, I think evaluating the fund manager is almost as important as the fund, right? I mean, I think, and understand, I like that idea of what is your repeatable process? Like, what's your process, and trying to understand their how they see this. I think that's really smart. So private investments come with limited liquidity and transparency. How should an investor decide whether the potential return is worth giving up that flexibility.
Yeah, and I think the overall, like if you look at like long-term returns, and most of the just big caution it by most of the research has actually been done based on private equity. So we will see how private credit and real estate, et cetera, returns compare as more and more research is being done. But long way of saying is the long-term returns in private equity have historically beaten public market returns. So if you have a long-term, view in terms of your wealth and legacy, et cetera, there's good argument that you should be allocating to private equity, venture capital, and the like. And then where it then comes down again is to making sure you're doing that by choosing the right managers and having some diversification within your portfolio, which to me raises like a really big issue for the individual. And this is true on my experience as an institutional investor as well, is you want to be seeing as many opportunities as possible. The lingo is you want to have as large a wide a funnel as possible for the opportunities. Because if your financial advisor or however you're accessing private markets is showing you one opportunity, it's really hard to decide, is that the best opportunity out there, and is it going to be better than anything else I can do? So just trying to widen your funnel as wide as possible to see the best opportunities, and then making that repeatable process, the strong team, et cetera, to make that decision on what the return expectations you hope to get out of the fund.
Is there a I guess the question is, you look at your portfolio and you say, okay, I'm going to put 10% or 20% into private markets. Maybe I have a higher risk tolerance. Maybe I want to be aggressive. Is there I don't like percentages. I'm not I don't do it that way. But is there a percentage or a framework or something that you have that sort of lets people know, this kind of investment is for me, this is where my tolerance might be? Does that question make sense?
No, it makes perfect sense. And
okay.
So a friend of mine, Patrick Campbell, and I, in one of an earlier articles that we wrote, we actually came up with that kind of a framework, and I translated that in the book as well, to think about how do institutions think about why does an endowment commit 50% of their capital to private markets, whereas certain insurance companies only allocate like 5%. They're very large institutions. They'll be around for a long period of time. There's different reasons that are driving their allocations. And what we try to do, and what I try to show in the book, is translating those frameworks to individual families, and then gave some family examples of, okay, this is a family that has a certain amount of assets, et cetera, and convert that into the percentages. So where it really came down to was stability of income, stability of expenses, recognizing that you may have unforeseen expenses, and your time horizon. Am I trying to build legacy wealth, or am I trying to just sort of have enough to, not to live on, but, and leave a little bit to family or charity? Or is this something that I really want to go beyond, my heirs, my direct heirs? Okay.
So it's a lot more questions than that, really, right? It's trying to dig into a little bit more than just I should do 10% or 15% or 20%, right? It's some deeper questions.
Absolutely.
Which makes sense. Well, what is I'm just out of curiosity, what is the average portfolio sort of, percentage wise, what are people doing now? What's the norm?
Yeah. And it depends, not unsurprisingly, it depends on wealth, right? So, so what people who are defined as ultra high net worth, which is having like $30 million of investable assets and greater, is like 30% or so, and maybe even more than 30%. High net worth individuals, those who've got $1 million more of investable capital, it's somewhere around the 15%.
15, right.
And then mass affluent, people like 100,000 to $1 million, it's much smaller percent. But having said that, there's now a push to get private markets into 401ks.
Yeah.
So you will see, I think, the opportunity and the percentage of even folks who are in the mass affluent will go up over time. It's small now, but it will go up over time.
Okay, good. That's good to know. Because I think that's probably where most people sit, right? And
sure.
So as people are listening to this today and they don't see the opportunity to know that it's coming and to learn a little bit before it, you have that opportunity, I think is really good. So I want to jump over. Well, you know what? Let me ask you about private credit right now. Where do you see the biggest opportunity there?
So the issue that private credit has right now is just that there's been so many redemption requests, and some funds have halted redemptions, and others have not. So I think the big opportunity for credit now, we were in this period of time where there was not a credit event. There was a very benign credit environment for a very long period of time, and it was really hard to distinguish between who the best credit managers were and who was not as good as those. And so I think the best opportunity now is really trying to figure out who the real quality managers are and who are not, and then contribute to the ones who have demonstrated that they've done well in a tough period of time.
No, smart advice. So if somebody finishes the book and is considering their first private market investment, what are 3 things you want them to do before committing the money?
So just making sure, again, that this is what really fits. You mentioned risk tolerances earlier. That you have the risk tolerance for this. You have the time for it. It's a more active management process than just putting your money in an index fund or an index ETF. So it's a more complex product. So making sure that you have the time. It's really building that funnel, and so it's going out talking to folks or getting on multiple platforms so that you're seeing multiple opportunities, and it's really trying to understand the breadth of private markets. One of the things that I get so excited about private markets as an industry is it's just expanded into lots of different asset segments, lots of different product types. There's continuation vehicles and secondary funds, and all sorts of things like that. Is really trying to understand just the basics of all those different opportunities. And then, so when you have a good lay of the landscape, then it's time to, that I think best for you then to think about going in, or if you made the decision not to go in, just wait. We're in the early innings of the growth of private markets. So if you don't get in today, you're not shut out. It's not a big deal. I'd rather people be very informed than feeling like they need to, the FOMO effect, right? I need to jump in. That's not an issue here, I believe, with private markets.
Well, one of the things I appreciate about you is the work you're doing with young people. But you have this organization called Youth Work Connect.
Yeah.
And I appreciate that because, I think it is hard out there for young people today. It's harder than I think it probably was. You and I have a little bit of gray hair. And I think when we were coming along, we did what we needed to do, and we had a lot of opportunity, right? And not that there's not opportunity out there today, but I think it's harder. And I think with all the changes going on in the world and the speed of the way that change is happening, I think it certainly makes it more difficult. Talk about We Work Connect, or Youth Work Connect, sorry.
Yeah. again, I appreciate you raising that as well. And our like in its simplest way, it's like we think about it. It's not what you know, it's who you know. And so, there's a lot of super talented kids out there, and we're very focused on high school kids. So there's a lot of super talented kids out there who don't have their families, for whatever reason, don't have the connections to get them internships or first jobs, et cetera. And so we're incredibly focused on helping these kids build professional connections. And the term in academia is social capital. We talk in terms of professional connections with the kids. We really want them to build the social capital so that they can make informed decisions about what college they want to go to, if they want to go to college. Maybe they want to go to the military or a community college or start working right away. But talk to, it goes back to a little bit of, on the private market side. Talk to as many people as you can who can help inform you. But what we really want to do is help the kids be able to go out and make those connections with people, not hesitate, to know what questions to ask them, to probe, and to help them make good career decisions. And in the second part of what we're trying to do is work with employers so that as they hire young people in internships or summer jobs or what have you, that they are very intentional about spending or giving their social capital to the students and introducing them. If the young person is interested in finance, let me introduce you to someone else in the company who may know about finance, or someone, some other professional who I can connect you with. Or let me tell you about my career journey at whatever college I went to, et cetera. Just being very intentional about sharing their social capital with young people.
Well, I can't speak about that enough. That is amazing work, because my kids both have had opportunities because of our network, or their parents' network, and that has benefited them tremendously in terms of where they went to university and the jobs that they now. One of them is still in university, but the summer internship he did this summer, and then my son just got a new job because of a friend of mine. Right. And so it is that social capital that you talk about is how the world works, and
it really is. And unfortunately, if you don't know it, you just lose out. And I would say the universities are doing a great job, really helping their students understand that. But not everyone goes to college, and so we don't want to leave anyone behind, and we want to help them build a muscle in high school so that even if they do go to a college, they're able to take advantage of the opportunities that are presented to them.
Yeah, I mean, I've got stories upon stories of people, whether they went to college or not went to college, who've built businesses on social capital, on how they network and how they show up at events in the community, and how they, and it's just such a critical point that where's my phone? I don't even keep my phone near me, but these things right here, they're useful, but they're a tool and they're not everything. I mean, this one-on-one dialogue is super critical, and I think that's I'm glad you were taking that on. So
well, thank you. It's been I've learned a lot with it, and really enjoyed working with the kids that we've worked with.
Well, Stephen, where can people buy the book? Steve, where can people buy the book? And talk a little bit about that, how they can get in touch with you if they want you to speak, if they want to learn more about Youth Work Connect. Talk about that for just a second.
Yeah, no, that's great. So for the book, it's available on Amazon, and they can folks can also go to my website, which is Private Markets Navigator. And there, you can get the book, but you can also read a bunch of the articles that I've been writing over the last several years as well. And then if people are interested in Youth Work Connect, we have a website for that as well, youthworkconnect.org. And both places, there's ways to contact me, and happy to speak to folks on either topic.
All right. Well, the new book is Investing in Private Market Funds, Institutional Strategies for individual investors. Stephen Blewitt, thank you for being with us here on Bestseller Live. We will see you next week.
Right. It was a pleasure. Thank you.